Good morning, everybody. Today we are looking at the latest developments in the financial reporting and accounting world. This is a client seminar or a client presentation that was presented in Melbourne on the 7th of May, but today, a few weeks later, we're doing the webinar version. So if you've missed that client seminar, happy that you can join us today for the webinar. I thought I'll start with a question to see whether you have all found the chat room or the question box. And the question is, which coach on The Voice Australia do you like the most or the best? So is it Ricky, is it Joel, is it Kylie, or is it will.i.am? So if you can let me know on the right-hand side, there's a question box. If you can send me who you would like to vote for. All right, it looks as if Ricky is a strong favourite. Definitely at the moment. Come on, you have to vote for somebody else as well. Everybody's voting for Ricky. I agree with you, Tony. Patrick, I like Ricky Martin too. Brendan, a bit of an alternative with Joel. That's good. We need a bit of alternatives too. Few people for Kylie. You know what's the interesting question of everybody? And we've got, wow, more than 100 people online. I've only got 2 people that said they don't watch the show. Isn't that interesting? So The Voice must be really popular with accountants. That's the research finding for today. The Voice is a popular show not only with my kids, but also with accountants. And I love The Voice too. All right, so a quick introduction. So you'll see on the right-hand side, you found the question box. If you want to send me a message, you are more than welcome to send me a question, and I'll try to work it into the presentation. I'm warning you, I'm a bit of a steam train, so you might have to be persistent. If time permits, I try and repeat your question, and then I try and respond to your question. You know, if I don't respond to your question, you're always welcome to email me afterwards or phone me afterwards. I would love to speak to you about your questions. But I will try and keep an eye on the question box as well. So please feel free to pop in a question. All right, so let's move on. In today's session, roadmap for today's session, only 4 parts. Number 1, new mandatory standards for 30 June 2014. Now, I would imagine that's what most people would be interested in. We're all trying to get ready for 30 June, preparing financial statements, getting ready for the auditors to arrive. So what are the new mandatory standards for 30 June 2014? Then in number 2, I'll look at the ASIC focus area for 30 June 2014. Now, these have not formally been issued by ASIC, but usually you know, you can get some clear indications by attending meetings with them or attending meetings at ASIC. Usually, you get a good grasp or feeling for what will be focus areas. And the other thing is the focus areas don't change that regularly. So whatever we had on 31 December 2013, chances are very high it would still be a focus area for 30 June 2014. So most of it I've based on the information I had for 31 December 2013, and then a few guesstimates. Section 3, we look at 2 new ASIC regulatory guides. Now, these guides are specifically directed at directors and also audit committees. So I would like to highlight those 2 regulatory guides to our clients. And then number 4, a bit of latest developments. And with great excitement, I have to say there's been a latest development within this week. The International Accounting Standard Board and the American Standards Board have finally issued the new standard, IFRS 15, on revenue recognition. So it's not been issued in Australia yet. We'll expect it within the next 4 or 5 months, because they now do a 2-stage approach. They issue standards twice a year, and then it's a whole omnibus of standards. So we expect to see that one within a few months. but only applicable around 2016. So very exciting, a latest development 2 days ago. So if we start with session 1, new mandatory standards for 30 June 2014, the first and most important thing is that we've got a new set of consolidation standards. So the AASB has issued 3 new standards which will impact accounting for subsidiaries, joint ventures and associates. AASB 10, consolidated financial statements, AASB 11, joint arrangements, and AASB 12, which would contain a lot of disclosure requirements and disclosure of interest in other entities. Now, we've had a webinar a few months ago, earlier in the year, on AASB 10, and we've also had a webinar on AASB 11. I'll touch on both those standards again today, but if it's your first time joining us and you would like to have a webinar or listen to a webinar that's looking at each of those in more depth, please contact me and I'll send you a link to that recording, or you could go and look at the Pitcher Partners YouTube channel and you would find the recordings there. A few key changes at a very high level. If we look at AASB 10, AASB 10 replaces the existing or now old definition of control, and it also incorporates the old AASB interpretation 112 on consolidation of special purpose entities. But I'm not going to go on about AASB 10 too much at the moment, because in a few minutes' time I'll spend more time on it. This is just very high level. AASB 11 sets out a new framework for the accounting of joint ventures. AASB 11 is looking at joint arrangements, how we determine whether it is a joint arrangement within the scope of AASB 11 to start off with, and then also once we're in AASB 11, do we have a joint venture or a joint operation? And then I think the biggest thing is, and it pains me to say this, the Australians have had it right all along, because before the adoption of IFRSs in Australia we said no proportionate consolidation for joint ventures. Then in 2005, when IFRSs came into Australia, we were kind of forced to proportionate consolidation. So if you had a joint venture, you had an accounting policy choice between equity method and proportionate consolidation. And now with the issue of AASB 11, there's no more proportionate consolidation. So we're going back to the place where Australia was before the adoption of IFRSs in 2005. So it's full circle. And then AASB 12 contains updates and combines the disclosure requirements for subsidiaries, joint arrangements, associates, and other similar entities. So if you want to know what to disclose about any entity where you've got an investment in, you go to AASB 12. AASB 10 and 11 do not contain any disclosure requirements per se. Application dates. Now these 3 new standards are effective for annual periods beginning on or after 1 January. Therefore, if you've got a 30 June year end, 30 June 2014, in a month's time, is the first time that you have a mandatory application of these 3 new standards. Early adoption was available as long as you've adopted all standards simultaneously, all 3 of them. So important for 30 June reporting dates. However, I hope you didn't have a heart attack if you're a not-for-profit entity. If you're a not-for-profit entity, AASB 10 only applies to you for financial years beginning on or after 1 January 2014. Now, a lot of not-for-profits have 31 December year ends, and therefore for 31 December this year, they'll have to apply AASB 10. However, if you're a not-for-profit with a 30 June year end, mandatory application would be 30 June next year. I would have to compliment the AASB in this respect. The reason I have to compliment them is I used to criticize them. I used to say that they just take IFRSs and just force it onto not-for-profits without really thinking how it should be applied within a not-for-profit environment, and without giving us extra guidance, implementation guidance for not-for-profits. And we have to remember that the International Accounting Standards Board, when they develop IFRSs, they focus on for-profits. That's their mandate. They look at for-profits, they look at big listed groups in the for-profit industry. And therefore, I've always argued that the AASB have to pick up on their mandate to look after not-for-profits, and they've done that. In October last year, they've issued amendments to AASB 10, which specifically explains how AASB 10 should be applied to not-for-profits. It's included in Appendix E to AASB 10. So if you're a not-for-profit, there's something for you to have a look at. I would now like to look at a few standards, and I'll start with the consolidation ones, but I'll also look at another mandatory standard, AASB 13. The intention is not to look at them in great depth because I don't have the time within an hour, but to give you a very high level of what changed in AASB 10, and as I said earlier, we do have a webinar on AASB 10, and obviously you can contact your Pitcher partner or staff member, or you could contact me and we can discuss it with you in greater detail. So let's start with AASB 10, Consolidated Financial Statements. Now, as I said earlier, there's a new definition of control. Now, control exists where the following three criteria are met. One, the investor has power over the investee. Number two, the investor is exposed or has exposure or rights to variable returns from its involvement with this investee. And the investor has the ability to use its power over the investee to affect the amount of the investor's returns. So if you meet these three criteria, then you have control. Why is it important to know whether you've got control? Because if you've got control, you have to consolidate and prepare consolidated financial statements in terms of AASB 10. Therefore, important to know whether you've got control. This is a huge conceptual change from the clear, bright line of 50% that we had in the past. So in the past, it was so easy. If you have more than 50% of the shares in the investee, if you have more than 50% of the voting rights at the board of the investee, as soon as it's more than 50%, you control, you consolidate, clear-cut, bright line, end of story. With this new definition of control, we don't have a bright line. It's now judgmental. It is, look at facts and circumstances, reconsider. Therefore, quite a significant change in the way we think about control, and do we have to prepare consolidated financial statements. So how would we approach this assessment? Before I look at this, I think it's crucial that our clients, as soon as possible, assess whether they control investees. So even though you've prepared consolidated financial statements in the past, even your associates which you've equity accounted in the past, we need to make an assessment before the auditors arrive on whether we control this investee and whether we should therefore consolidate this investee. The application of AASB 10 is one of the focus areas of ASIC. I'm letting the cat out of the bag. They are focusing on the application of AASB 10 as a new accounting standards, and therefore they would ask, now, how did you make this assessment as directors, as an entity, that you've got control or you don't control? So how do we approach an assessment? Step one would be to identify the relevant activities, to identify the activities, the relevant activities, the significant activities, the key activities of the investee. So it's not just identify all activities. What are the significant, the key, the most important activities of the investee? Number two is to evaluate the power, as in who has the power, which investor has the power over the relevant, the key activities of the investee. And then step three is to assess the returns, therefore who would be exposed to the variable returns. So that's the approach. So if we look at a bit of an example to give you some idea, And also to illustrate how subjective this is, if two investors form an investee to develop and market a medical product, and one investor has the responsibility and the unilateral ability to make all decisions relating to product development and to obtain regulatory approval, and then once the regulator has approved the product, the other investor has the responsibility and unilateral ability to make all the manufacturing and marketing decisions. The question is, which investor has power over the investee? In this example, very important that we say that in this situation we've got two investors, and we would say both aspects are important. It's important that we get medical approval for our product, but it's also important that we do the marketing of our product. So if we've got two activities who both significantly affect the returns, if we say yes, both of them significantly affect the returns, we should say which activity most significantly affect returns. Now this is a big judgment call. Which activity most significantly affect returns? If you say no, there's only one activity that significantly affect returns, then you will consider who has the power and who are exposed to returns. So this is the one that I think we've got in this example, where we've got two activities, both affect returns, so the judgment call is which one would most significantly, and can that change? Now I think it would be really hard to argue that while we're trying to get medical approval, that entity has control, and once we've got medical approval, the other entity who's in control of marketing has control or has the power. I think if you look at that, the facts and the circumstances in my mind hasn't changed. Right from day one, we knew one will take charge of medical approval or obtaining medical approval, and another would be in charge of marketing. I think it comes back to those magic words, business model and strategy. Because on day one, we know this is the plan, these are the facts, these are the circumstances, these are the contracts. The question is, based on our business model, which would be the most significant right from the start? Is it a kind of a product, let's say it's a cure for AIDS or a cure for a certain rare cancer, that will take a lot of time and it will be very difficult to get medical approval, and there's a big chance that it might not happen? Then the entity that has power over that, I think, would have control. However, if it's just another kind of medicine to treat headaches, similar to a Panadol or a Nurofen, and we think to get medical approval, is a process, but it's, it will happen. But the key thing while we're doing this is we've got all these fancy marketing channels, marketing strategies, and if our business model is around our marketing strategies and channels, I believe the entity that's in control of the marketing has the power and should consolidate the whole time. I think you only reassess if there's a change in facts and circumstances, but it's highly judgmental, and that's what I want to illustrate. In my next example being, what if we've got an example where one investor is responsible for manufacturing and another investor is responsible for marketing? Which activity has more effect on returns? Now again, you have to think, if you look at this investee, what is the business model? What is the strategy? Is the business model that we can do amazingly cheap manufacturing, and our business model says that is our key to success? Or is our business model our amazing marketing and marketing channels? So it comes down to the investee's strategy and business model, and therefore we have to understand that strategy, that business model. We have to document that, provide evidence of that, so we can determine who has the power and who will be consolidating. So in my in example B, I said if we've got a low-cost manufacturer and a commoditized product, that could be the critical part. If it's a high-end branded product, we could say the effective marketing is the critical part. So It's facts, circumstances, judgment, and all of this assessment has to be documented. Another thing that I want to highlight about control is the concept of de facto control. Now in Australia, we had de facto control before 2005, before the introduction of IFRSs. And we again are going back to that position. To try and illustrate de facto control, let's say entity A owns 40% of the shares in entity B, and the other 60% of the shares in entity B are held by 120 different shareholders. In this situation, I'll give you some more information. Let's say these 120 shareholders rarely attend shareholders meetings, rarely vote. If they vote, they don't vote together. You know, they all have different views and vote whatever they personally think is the case. Let's say it's 120 mum and dad investors. In that situation, although entity A don't have the old bright line of 50% of the shares or the voting rights or the power, one could argue, and with the new standards one should argue, that entity A, due to the control over 40% of the shares and due to the fact that the other 60% of the shareholders are not really involved, entity A has control and entity A should consolidate entity B. So can you see it's not about the percentage? If you look at situation 2, if we have the same situation where entity A owns 40% of the shares in entity B, but the other 60% are held by 2 different shareholders, in this situation, although entity A has 40% of the shares, the 2 other people who each have 30%, they could get together over a cup of coffee, decide how to vote, and entity A don't have control. I think it's very likely that the other 2 shareholders could make decisions together or at stages vote together. Therefore, in that situation, entity A don't have control, only significant influence, and should use equity method of accounting. Can you see, in my example situation A and in situation B, in both situations, entity A has 40% of the shares, but in situation A, entity A has control. And in situation B, entity A don't have control. And it's because we have to look at the bigger picture and not focus on the bright line of a percentage of shareholding. So that's a bit on de facto control. So what are these other facts and circumstances that we should consider when we decide whether there's control or not? Not just looking at the bright line and the shareholding. One should look at the contractual rights arising from other arrangements. If there are other contracts that change arrangements, it's not just shareholding. We should look at the size of the investor's holding of voting rights, but relative to the size and dispersion of other vote holders. So you look at the voting rights an absolute amount, you look at the voting rights relative to other vote holders, so a relative amount. You look at the number of vote holders that could vote together. You look at voting patterns, past experience, whether they've attended meetings, whether they've voted together. So all of those things should be documented, taken into consideration to decide whether you've got control and should consolidate or not. I think the biggest potential impact of the new AASB 10 would be on entities where you, in the past, assessed that you have significant influence and therefore you've used equity method of accounting. So in the old days with the bright lines, if you had an investment in an investee between 20 and 50%, usually we would have argued that it's significant influence, it's not control, and we would have used equity method of accounting. After the introduction of AASB 10, I believe we have to go back to those associates and document very carefully whether we only have significant influence or whether we perhaps have control and should consolidate. And that is something that you should do as soon as possible and discuss with your advisor from Pitcher Partners. So it's all about judgment, and it's about documenting your judgment, because ASIC, it's on their hit list, could come and ask you for what did you consider, what did you take into account to determine your judgment. The auditors will definitely ask you, how did you get to this judgment? provide evidence of all the facts and circumstances which you've discovered and discussed. So judgment really important. And then the next thing, it's important to document your judgment. Everything that you've considered, all the facts, all the circumstances that led you to your judgment should be documented. And when we look at AASB 12 a bit later, you'll see that you actually have to disclose your assumptions and your judgment on whether an entity should be consolidated, that is, there's control, or whether it's significant influence or a joint arrangement. So yes, you have to document it for ASIC, for the auditor, for yourself, but also for disclosure. And the sooner we get to this, the better. So that is AASB 10, very briefly. If we move on to AASB 11, joint arrangements, maybe before we start, I'll have to ask you a question. I look out the window in Melbourne, and you will not believe it. It is the most beautiful blue skies, not a cloud in sight, no rain. So I'm actually feeling very happy. This South African feels very happy. My question to you, wherever you're sitting, what's the weather like? Oh, I've got some people saying freezing. That's a bit of a problem. Bridget, cold in Bendigo. A few clouds, Nick, yeah. Overcast, wow. It's not often that I can say Melbourne's got the best day in the world. Bridget, you will remember Melbourne weather. Oh, first clouds I've seen in Sydney for months. That's Rod. Rod, I've been in Sydney Monday, Tuesday this week, and it was the best days. I think on Tuesday it was 28 degrees. I nearly had a heart attack. I just thought, what's going on here? I like the idea that I'm now Australian. I just don't sound Australian, but I agree I am Australian. I have a passport to prove. All right, let's go on. So I'm in a happy mood, blue skies in Melbourne, and if it's freezing in your part of the world, I hope tomorrow is a better day. At least it will be better over the weekend. AASB 11, joint arrangements. Now, when we look at joint arrangements, the very first thing we have to do is to determine whether we are within the scope of AASB 11 joint arrangements or not. So do we have a joint arrangement or not? Now, the first thing, and it's a two-step approach to make that assessment. The first thing is, does the contractual arrangement give all the parties or a group of the parties control of the arrangement collectively? So if you look at control of the arrangement, it is control as defined in AASB 10. So it's not the bright lines of 50% anymore. It is the power over the significant activities that impacts returns. So do two of the parties collectively control the arrangement, control as defined in AASB 10? If we say no, you're not in AASB 11. Look somewhere else. If we say yes, the second consideration, the second step is, do decisions about the relevant, important activities require unanimous consent of the parties who have that control? Not of all the parties, but the parties who have control. A key word here is unanimous consent. I cannot overemphasize the need to have unanimous consent. The example I'll give you, if we've got two investors that have an interest in an investee and each have a 50% interest, each can appoint two people to the board of directors. In that situation, if the two entities and the two people vote differently, we get to a situation where two say yes, two say no. What do we do now? How do we resolve that situation? And it's very important that then you go and look at what the contract says, who has the final say. Because unless unanimous consent by the two investors are required, you don't have a joint arrangement. If the contract says the chairman has the final say, you could still potentially have unanimous consent because that's just a circuit breaker. However, my question would be, who appoints the chairman? If entity A always appoints the chairman and the chairman always have the final say, then we don't have unanimous consent. Then we're not within the scope of AASB 11. So this arrangement would be within AASB 11 if at least two of the parties collectively have control and if they are required to have unanimous consent to make their decisions. And if we say yes to both of those, we've got a joint arrangement. Once we've got a joint arrangement and we are within AASB 11, we have to decide, do we have a joint operation or a joint venture? Now, a joint operation is where parties have rights to assets and obligations for liabilities in respect of this joint arrangement. So certain entities could say, these are my assets, those are my liabilities, I'm responsible for those liabilities. A joint operation often would be a situation where the two parties work together and whatever they produce, they split between the two parties involved in the joint operation. Usually a thing to look out for would be who would be responsible for liabilities of the joint operation. If the two parties would be jointly and severally responsibility for the liabilities of this joint arrangement, it often is a joint operation. A joint venture is a slightly different thing. That is where the parties have rights not to specific assets and are not responsible for specific liabilities, but they have rights to the net assets of the arrangement. And usually, if the joint arrangement are not paying their creditors and their liabilities, they cannot come after the parties involved. So that's part of the thing to look at. Is there a limitation or is their risk limited to what they've put into this joint arrangement or not? So if we want to make a different diagram to consider this, if you've got a joint arrangement that's not structured through a separate vehicle, then it's a joint operation. However, as soon as it's structured through a separate vehicle, and it doesn't have to be a separate legal entity, just a separate vehicle, you should also consider what's the legal form of the vehicle. It could even be a silo within an entity. You have to look at other contractual arrangements which could determine whether certain people have rights to assets or responsibilities for liabilities. And you should also consider all other facts and circumstances. Once you've got a joint arrangement, it's a very judgmental decision on whether you've got an operation or a joint venture. And you have to be very careful to consider not only the legal form, but the contracts in place, the facts, the circumstances. Another thing is quite often, if we go back, quite often a joint venture is formed to make a profit. Quite often that joint venture would generate its own cash flows. A joint operation, on the other hand, often structured to operate at break-even, and often they don't generate their own cash flows, but cash flows would come from the parties involved. So there's a lot of things to consider, and those are just really rules of thumb. So if you want to decide whether you have to classify a joint arrangement as a joint venture or a joint operation, this is a decision tree you could use. First question would be, is this joint arrangement structured through a separate vehicle? If you say no, joint operation. If you say yes, you consider the following. Does the legal form of the separate vehicle give the parties rights to the assets and obligations for the liabilities? If you say yes, joint operation. Then, do the terms of the contractual arrangement specify that the parties have rights to their assets and obligations for their liabilities? If you say yes, joint operation. Final question, are there any other facts and circumstances that give the parties rights to their assets and obligations for the liabilities? If you say yes, joint operation. If you answered no to all of those, you have a joint venture. So very high level on AASB 11, there's a whole webinar on it. If we move on to AASB 12, this is now disclosure. Very important, as we said earlier, that you have to disclose your judgment. So you have to disclose the significant judgments and estimates that's been made in determining the nature of its interest in another entity. So whether you've got control, significant influence, joint arrangement, and if it's a joint arrangement, whether it is a joint operation or a joint venture. So not only do we have to document this as soon as possible before the auditors arrive or before ASIC asks us, but we have to disclose it so our users know. There are also some additional disclosures, and additional disclosures specifically around unconsolidated structured entities. So you could have structured entities that are not controlled by the entity. So unconsolidated structured entities, and there's specific disclosures around them. So a lot of the last one on this slide, details of interests and risks in these unconsolidated structured entities, but also if there are any restrictions in subsidiaries, if there are any risks associated with consolidated structured entities, we have to disclose it. Summarized financial information for all joint arrangements and associates, details of material non-controlling interests, the nature of contracts for joint arrangements, all of this we have to disclose. So AASB 12, a lot of disclosures around investments in subsidiaries, associates, joint arrangements, but even these unconsolidated structured entities. The next mandatory standard that I want to look at is AASB 13, fair value measurement. So in the first part of the webinar, we've looked at the new consolidation suite of standards, 10, 11, and 12. And now we move on to AASB 13, fair value measurement. A bit of an overview. In the past, a number of standards could have potentially required fair value measurement. For instance, you could revalue property, plant and equipment. Financial instruments could be recognized at fair value. Investment property could be recognized at fair value. And then all those standards also provided guidance on how to determine fair value. Now these days, all those standards would stop with you recognize or you measure this item at fair value, end of story. If you want to know how to determine fair value, you have to go to AASB 13. So AASB 13 gives you all the guidance on determining fair value and also a lot of additional disclosures. Please note, a lot of additional disclosures, a lot of preparation to get that ready for 30 June financials. It even applies to not-for-profits because AASB 1004 contributions would say contributions should be measured at fair value. How do you measure that fair value of the contribution? You look at AASB 13. So what's the definition of fair value? AASB 13 defines fair value as the price that would be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants at the measurement date. So very important. Fair value is an exit price. It is to sell an asset, to exit, to sell an asset, or to pay somebody to get rid of a liability. In the past, there was always a lot of discussion and debate whether it's an entry price, whether it's what you pay for an asset or what you would pay for a similar asset. No, it's an exit price. If you want to sell this asset, what could you sell it for? So an exit price is what an entity expects to receive when we sell an asset or pay when we transfer a liability. Very important. So important, it's the only words on my slide. It's a market perspective. Fair value is a market perspective. It's not what the entity thinks the fair value is, but what the market thinks the fair value is. So even if an entity can use an asset in a very unique way, and therefore in their mind this asset is really valuable, The question is, if we sell this asset in a market, what will the market pay for this asset? That is fair value. So please remember exit price. So if we look at a few key elements, a key element is the market, and we have to ask the question, what is the principal market? So what does that mean? That is the market in which the entity normally transacts. What's the principal market to sell this asset? In what market would we normally sell this asset? And we look at a price in that market. If there's no principal market, we look at the most advantageous market. But can you see the order? First, what is the principal market? Where do we usually transact? And only if there is no principal market, then do we consider the most advantageous market. And then very important, when we look at the definition of fair value, I want to say stop in your tracks. As directors, as owners, as management in businesses, please note that the requirements of AASB 13 to determine fair value is not necessarily the same as the international valuation standards that valuers use. Therefore, if you want fair value to be determined by a valuer for use in financial reporting and financial reporting standards, it's really important that you make sure, that the valuer understands that they have to comply with the measurement requirements of AASB 13. So I'm going back to stop. If you use a valuer, have you given your valuer clear instructions to comply with the requirements, the measurement requirements of AASB 13? Very important. Then some special considerations if you've got non-financial assets. So if you've got non-financial assets, for instance, property, plant and equipment, and you are determining fair value, special consideration is the concept in the third bullet point of highest and best use. And highest and best use says that the fair value of a non-financial asset is the price that would be paid by a market participant given the best use that can be made of an asset irrespective of the current use. So we're not saying how are we currently using an asset, we're saying what is the best use that I could make of this asset. Example, if we currently use an asset as an aged care facility, but the best use of that asset would be to build a high-rise, somebody would be willing to pay you a lot of money to get hold of that property to build a high-rise of residential developments. So that's the best use. So important that we don't say what do they currently use it for and what's the fair value for the current use, but what is the best use that can be made of that property. Just want to go back. However, when you consider best use, you have to consider potential legal restraints. So if you can only use a golf course as a golf course, then you cannot say the fair value is we can build houses here. I mean, you can only use it as a golf course. Or if you can only have a school there, if you can only have a hospital there, or you can only have an aged care facility there, I mean, you have to take that into account in determining best use. So when we look at valuation techniques, it's important that we maximize the use of observable inputs. And that means market observable inputs, and that we minimize the use of unobservable inputs, something that we cannot get out of the market. So we want to try, when we use a valuation technique, when we use discounted cash flows, we want to try and use cash flows or a lot of components in this cash flow model that we can observe out there in the market. So disclosure requirements, and this is important if you prepare financial statements, that we now have 3 levels of disclosures about fair value, and it's the same levels that we've always had for financial instruments in AASB 7. So if you are measuring fair value for any item, you have to do the 3 levels, where in the old days we only did the 3 levels for financial instruments. Now level 1 is fair value is determined with reference to a quoted price in an active market. It's important to tell users if it's level 1 because there's a lot of it's reliable and users can trust it because it's determined by a market. A level 2, fair value is determined using input-derived market information, but it's not directly quoted in an active market. So it could be in a market with a slight adjustment. So, example, the house next to us sold for $500,000 right next to us, but our house is not worth $500,000. Maybe our block of land is slightly smaller. We don't have a swimming pool. We have less bedrooms. Therefore, although our starting point is the $500,000 next door, we adjust it to get to $450,000. That is an input-derived market information. Now you have to be careful. As soon as you use a lot of adjustments and assumptions that are not related to the market, you are in level 3. Or if you just have a valuation technique with very limited market information. So there's always this question, are we in level 2 or level 3? Usually I would say you are in level 3 unless I can see the very strong influence and link to market information that's been slightly adjusted. That would be level 2. So why do people often ask me, are we in level 2 or level 3? Because if you're in level 3, you also have to disclose additional information, a reconciliation between the opening balance and the closing balance, explanations of movements during the year. So it's not just to put it in level 1, 2, 3 in the hierarchy, but level 3 have additional disclosure requirements. So be careful for that one. So things to remember about AASB 13. The new AASB 13 may impact the selection of an appropriate valuation technique, and you might have to consult with a valuation expert. But please note, if you use independent valuers, consider the instructions that you give them. Please put an emphasis on the market perspective and that it should not be a valuation based on current use, but what the market could use it for, the best use. Very important that they realize that they have to comply, the valuers have to comply with AASB 13, otherwise you could waste your money and will have to get another valuation. So AASB 13, a to-do list, as soon as possible. Number 1, identify the items measured at fair value. Number 2, evaluate whether the current basis for the fair value of these items are in accordance with AASB 13 or not. Number 3, consider whether you need to use an independent valuer, and if you need to use an independent valuer, consider the instructions that you have to give them. The other important thing that I should say is AASB 13 is a prospective standard. So all these disclosures and fair value measurements applies to fair value at 30 June 2014. You don't have to go back to 30 June 2013. The next one I want to look at is AASB 101, presentation of financial statements. There are 2 changes about AASB 101. The one is about the title, and this is just ridiculous. The old income statement or the profit and loss changed to the statement of comprehensive income a few years ago, and the statement of comprehensive income is now a bit of a combination of the old income statement and other comprehensive income at the bottom, and other comprehensive income at the bottom are revaluation reserves, foreign currency translation reserves, revaluation of property, plant and equipment, revaluation of available for sale financial assets, cash flow hedges, etc. And now they said the old statement of comprehensive income, the title now changes to the statement of profit or loss and other comprehensive income. I think it's because they couldn't think of a longer title, but I suppose conceptually it is to provide a clearer explanation of what's included in this statement. You can still use the title Statement of Comprehensive Income, And when we at Pitcher Partners produced our model set of accounts for clients, which by the way are available now, that model set of accounts we still use statement of comprehensive income. So you could use statement of comprehensive income or this very descriptive, very long title, which I don't particularly like. So that's the one change. The other change is in the statement of comprehensive income, at the bottom where you look at other comprehensive income. So remember, there's profit for the year. There's the top part, you get to profit for the year, and then you get to other comprehensive income. Other comprehensive income, you now have to distinguish between items that will not be reclassified to profit or loss in future and items that may be reclassified to profit and loss in future. So if in the current year you revalue property, plant and equipment, in this year where you revalue property, plant and equipment, you have to nominate whether that revaluation could end up in profit and loss in future if you sell property, plant and equipment. Now the answer is, what will never end up in profit and loss? If you've revalued property, plant and equipment, it won't end up in profit and loss. It will be a direct transfer from the reserve to retained earnings in the statement of changes in equity. Also remeasurements of defined benefit plans. What could in future end up in profit and loss? Exchange differences on foreign operations, that foreign currency translation reserve could be washed through profit and loss in future. If you've revalued available for sale financial assets and you sell them in future, it could go through profit and loss, and also cash flow hedges could go through profit and loss. So it's important that you know about this additional disclosure in the statement of comprehensive income. The next section, section 2, looking at ASIC focus areas for 30 June 2014. We are waiting for ASIC's media release, which will be the formal document, and as soon as we have it, I will distribute it to all our Pitcher Partner clients and contacts. So if you've registered for webinars, I'll be sending it to you as well as soon as we've got it. At the moment, it's a bit of a guesstimate. It's a bit of a guesstimate based on meetings I've attended fairly recently, discussions we've had, and also focus areas for 31 December 2013. So high level, what are these focus areas? I'm not going to spend too much time on them because I'll send you a final media release. Revenue recognition and expense deferral. Rod, fantastic. Rod said they've released the media release this morning. So please look out for the Pitcher Partner newsletter very soon. Thank you very much for that, Rod. Revenue recognition for all our revenue streams. Do we have an appropriate, relevant, correct accounting policy? Is that accounting policy actually applied? So revenue recognition is a big thing, but also expense deferral. Should expenditure be capitalized as an asset or should it be expensed? Please be very careful when you want to capitalize. Make sure you meet the definition of an asset and the recognition criteria of an asset, and that there indeed be future economic benefits. Also look at asset values and impairment testing. Are you happy with your asset values, specifically if you use fair value to come up with asset values? And have you disclosed it in the 3-level hierarchy? And also impairment testing. Consider whether there are indicators for impairment, and if there are indicators for impairment, have you done an impairment test? I've had clients where ASIC contacted them and said, everybody in your industry have impaired a certain asset. Why have you not done it? Could we please see your impairment test calculations? Remember, there are certain assets that have to be tested for impairment annually. That would be goodwill, intangible assets that are still in the development phase, not ready for use yet, and also intangible assets with an indefinite useful life. The third one is always there, going concern. Directors have to make an assessment whether the entity is a going concern from the date that they sign the financial statements, not the reporting date. Directors have to sign a director's declaration, whether they'll be able to pay their debts when they fall due and payable. And directors have to make that assessment independent of the auditors and before the auditors have a look at it. The fourth one is financial instrument values. So if you've got financial instruments that are measured at fair values, how did you determine those values? Disclosed it again. The fifth one, ASIC has in meetings emphasized, and that is tax accounting, specifically disclosures around income taxes and deferred tax assets and deferred tax liabilities. So they're absolutely focusing on tax accounting. It's a fairly new area that they're looking at. So do we meet the recognition criteria to recognize deferred tax assets? So definitely be careful on tax accounting and applying AASB 112 income taxes. If you then go on the next page, estimates and accounting policy judgments. So note 1 is usually your accounting policies, and note 2 would be your significant judgments. As a director, where did you have difficulty? Where did you have to make assessments, assumptions, and apply your judgment? Non-IFRS financial information, and there's been an indication that that would no longer be on the hit list. We still have to apply with the regulatory guide though, but not the main focus anymore. I think most people have that right, that we shouldn't provide disclosures of information that contradicts IFRS information. And the next one is important, off-balance sheet arrangements, and that would be those unconsolidated structured entities maybe, or those unconsolidated special purpose entities we had in the old days, and specifically also the application of the new standards, so the application of the new AASB 10, 11, 12, 13. A related party disclosure is always important. It's important for users to know whether we've had transactions with related parties, that they were at fair value and market-related, arm's length. What are the extent of related party transactions and balances? Very important to know. The last one, disclosure in the operating and financial review, is one of the items that I think will be dropped off the ASIC focus area list this year. It came on about 2 years ago when there was a new regulatory guide, but basically it says that we have to disclose in our operating financial review our business model, our strategy, and I think again listed entities have got that right and have improved, and that's why it would have been dropped off the ASIC media release. In section 3, I would like to look at the new ASIC regulatory guide specifically for directors and audit committees. Now the first one, both of them were issued in March this year, a few months ago. The first one is ASIC Information Sheet 183, which talking about directors and financial reporting. Now this is a must read for directors, and if you're a CFO or the finance department, I think you should get this in front of your directors very quickly. It's all about directors have a duty of care and diligence under both general law and the Corps Act. And they re-emphasizing that a director is an essential component of corporate governance, and that each director is placed at the apex of the structure of direction and management of a company and what their roles and responsibilities are. Now you can imagine this information sheet would be as a result of the recent issues and court cases around Centro and other collapses, and just saying, directors, remember you've got a role and a responsibility, you have to take it seriously, and let's remind you what this would be. So as a director, you have a core, irreducible requirement of involvement in management of a company. So you must take reasonable steps to place yourself in a position to guide, to monitor the management of the company. So you have to be involved in management and monitor management. And at Pitcher Partners, that's why we're working on a data mining product to help directors to be more involved and to look at reliability of information provided by management using data mining. Directors, your responsibilities are not limited by your particular background, knowledge and experience. So if you're a marketing person, it doesn't mean you don't have to read the financial statements and understand the financial statements at a certain degree. You must become familiar with the business of your company, how it is run, and ensure that your company is being properly run by management. So you cannot be standoffish. You have to know what's going on. And then this one is important, is that directors, your obligation extends to ensuring that your company's records are complete and accurate through the adoption of appropriate accounting policies and the design, the implementation of appropriate controls and processes. So then, this is now important for 30 June 2014. That's why I say we have to get this to directors as soon as possible. In reading a financial report, you should ensure as far as possible and reasonable that the information included is accurate. You should question the accounting treatments applied. So can you believe it? Directors have to read Note 1 on accounting policy and whether that makes sense and whether that's been applied within the business. They have to examine the adequacy of disclosures and whether any matters have not been disclosed that should be disclosed, right, using their knowledge. They have to ensure that financial reports are of a high quality, are useful, meaningful information, and that's provided to the users of financial reports. So entities should have a culture focused on quality financial reporting, have appropriate governance arrangements and processes controls. They have to ensure the financial literacy of directors, and therefore I'm inviting you to invite your directors to these monthly webinars to address financial literacy. We're not going into everything in depth. Specifically, this webinar is a high level. Maybe they should look at the recording as a board together to make sure what are the focus areas for 30 June and are we across the focus areas. They should apply the accounting standards, apply their experience, their expertise, and consider accountability and internal incentives to make sure that we've got quality financial reporting. Then there's another one. So that was one information sheet, 183, but there was also information sheet 196 with the title Audit Quality, the Role of Directors and Audit Committees. You know, ASIC is always busy with auditors on audit quality, but now ASIC says, listen, this is a joint thing. Audit quality depends on the role, or on the involvement of directors and audit committees, and there's a role for them to play to enhance audit quality. So an auditor gives an independent opinion that follows after the director's opinion. The directors are responsible for internal controls, preparing financial statements, and giving an opinion and signing a director's declaration, and then the auditor gives an independent opinion. Therefore, a company must have its own systems, processes, controls, as well as appropriate resources to produce high-quality financial reports. It's not the role and responsibility of the auditor to do all of that. And that's, again, where we see a bit of a role for our business services division to work with clients and data mining as a process to ensure high-quality financial reports. So ASIC issued 2 documents in March talking about roles and responsibilities of directors. In the final section, and it's already 12:05, I do apologize, I'm running over time. I'll try and wrap it up fairly quickly. Latest developments are forward-looking, and that's why I've put them at the end, because it doesn't impact us immediately or at 30 June 2014. So if you have to leave, I'll understand that. This is a bit forward-looking. You know, currently we have 3 financial instrument standards, AASB 139, 132, AASB 7. And it's a complex set of accounting standards dealing with financial instruments. And during the global financial crisis, a lot of its weaknesses have been put out there and came to light very clearly. Therefore, and one of its big weaknesses is the accounting treatment of available for sale financial assets, and specifically the impairment of available for sale financial assets. Bridget, I remember we had some lovely conversations a few years ago around impairment of available for sale financial assets. They're still in my mind as a fond memory. Now we have AASB 9 financial instruments. And AASB 9 financial instruments has been released piecemeal, only to deal with recognition and measurement so far. So you can early adopt it, but there's still a lot. There's still a lot of parts that have to be issued. However, if you've got a problem around impairment of financial assets, available for sale financial assets, I recommend you consider early adopting AASB 9 to address that problem, because AASB 9 has three categories of financial assets only. We have financial assets at amortized cost, we have financial assets at fair value through profit and loss, and then the last category addresses the impairment problem of available for sale financial assets, and that is equity investments designated at fair value through other comprehensive income. And you've got an irrevocable election or opportunity to elect that investments in shares, equity investments, are carried at fair value, and that changes go through other comprehensive income, always the ups and the downs. So that is something that you could consider. AASB 9, the mandatory application is being pushed back. I think that we're now looking at 2018. So there is a risk to early adopt AASB 9 years ahead of its time, because we're not 100% sure what the rest will look like. But if you've got a big impairment problem, I'll definitely consider. This is a bit of a decision tree that could help you with the new AASB 9. So if you start with debt, what are the considerations to determine whether it's amortized cost or fair value through profit and loss? Or if it's a derivative, it's always fair value through profit and loss, similar to the current situation. And if it's equity, what are the potential decisions that you have to make to determine whether it's fair value through other comprehensive income, and that's your option. You can elect it irrevocable, or whether it should be fair value through profit and loss. What you can see clearly here, a debt instrument is either amortized cost or fair value through profit and loss. It's never fair value through other comprehensive income. The same way an equity instrument can only be fair value through other comprehensive income or fair value through profit and loss. It can never be amortized cost. So quite a nice visual expression of the very high level requirements of the new AASB 9. At the moment here, I've got potential new revenue recognition standard. The international standard was issued 2 days ago. So it's a new revenue recognition standard, IFRS 15, and I'll send a newsletter out very soon about this as well. And it's really a 5-step approach, which internationally in Australia we don't expect a lot of changes. However, in America they do expect quite a significant impact. And the steps that we go through is, first of all, you have to identify all your contracts with a customer and determine whether these contracts should be evaluated together or whether they are separate contracts. That's step 1. Then, whether you've got individual contracts or contracts together, you have to step 2, determine the separate performance obligations. So what do you have to do? What do you have to perform? Now, it could be that I have to give the client a mobile phone, plus I have to give the client airtime. So I've got 2 performance obligations if I'm Telstra. Step 3, what is the transaction price? So I've got a performance obligation. I have to give them a phone. I have to give them airtime for the next 12 months. What's the transaction price? They're going to pay me $50 a month. So I know what the transaction price is, step 3. Step 4 is to allocate the transaction price between the two performance obligations. What part of the transaction price is for the phone and what part of the transaction price is for the airtime? Step 5. You recognize revenue when you perform the obligation. So if I give my client, I'm Telstra, if I give my client a mobile phone, then the part of the transaction price that's for the mobile phone can be recognized as revenue. However, only when I provide the airtime to my client in future will that part of the transaction price be recognized as revenue. Now, I don't think this will have a huge impact on revenue recognition or the timing of revenue recognition in Australia. However, this will have a huge impact on the way we talk about revenue recognition because it's now all about performance obligations and no longer what we have in AASB 118, risk and rewards. Leases, as you all know, the International Board have been grappling with finance leases, operating leases for years. They want to get rid of operating leases. You can see the cross is not a cross that's colored in. I don't know whether they'll ever be successful. They've come up with a new ED where they are talking about recognizing all leases as assets and liabilities, but now they're differentiating between property leases and non-property leases. Personally, I think finance leases, operating leases are well understood. Conceptually, it makes sense. I don't think it's been abused by the smaller end of town, and I think a differentiation between property and non-property leases makes a bit of a mockery of the new requirements. I don't know where it's going to go. To be honest, if it's going somewhere, if there's going to be a change, it's years off, in my guesstimate. Therefore, you know, I'm not too worried about it, and I'll keep you up to date because, you know, they're going round and round in circles and no real progress from where I sit. A differential reporting update. In Australia, as you know, the first question is an entity a reporting entity? And if you say yes, you have to prepare general purpose financial statements. That's the green side on the left-hand side. If you are publicly accountable, it's tier 1. If you're not publicly accountable, you can use reduced disclosure requirements. The problem area in Australia is this special purpose area, the blue side or the aqua side. So if you're not a reporting entity, you prepare special purpose financial statements, and then there are a lot of question marks there. What standards do we have to comply with? Do we comply with recognition, measurement, disclosure, etc.? And the AASB at the moment is proposing to get rid of the reporting entity concept. And well, that's what they're thinking about. They're doing research about it at the moment. And they would want all the various regulators to determine what they want lodged with them. Do they want general purpose or special purpose? It will no longer hinge on reporting entity. For example, ASIC might say that as soon as you are required to lodge financial statements with ASIC, it should be general purpose financial statements. However, if they make changes to reporting entity concept, it will be at least 4 or 5 years off. It's a longer term research project, and I don't think they can just say everybody who lodge with ASIC should lodge general purpose, because at the moment apparently 90% of the entities who lodge with ASIC lodge special purpose financial statements. So if they go that way, I suspect they're also talking about increasing the threshold for large proprietary companies, therefore increasing the threshold to determine whether your financial statement should be lodged with ASIC and audited. So that's all in the cards. There's a research paper out on this. If you are interested in this kind of stuff, you know, we'll keep you up to date. It doesn't have an immediate impact. Other developments, there's a conceptual framework project where they're tinkering with the definition of an asset and liability. There's a proposed new format of the auditor's report. That would be a big shift for auditors, because auditors will be required to disclose key audit matters in the audit report. So what were the key things that they looked at and how they've audited that at a high level. That one It's expected to be issued in Australia later in the year and applicable within the next year or two. So the audit report is close. The conceptual framework is 5-6 years away. And in the future of the ACNC, personally, I would love for the ACNC to stay. I feel very passionately that not-for-profits need somebody to look after them and negotiate and get a better deal for them, reduce the reporting burden, etc. So I would love for the ACNC to stay. Not sure what's going to happen. There's a draft bill out at the moment to get rid of the ACNC, which was an election promise by the Liberal Party. A lot of people against it. And the problem with that bill is there's no indication what's going to replace the ACNC, and whether not-for-profits will just go back to ASIC, no idea. So that's a bit of an open-ended question at the end of the webinar. So we looked at new mandatory standards, we looked at ASIC focus areas, and I'll send a media release out very soon. Thank you for that information again, Rod. And there are new ASIC regulatory guides which you should put in front of your directors, and I think we should maybe get a webinar like this in front of directors to address financial literacy. And then the latest developments is just a little bit of a look at the future. Not sure what's going to happen, but my limited comments on what I expect to see over the next 5 years, let's say. I'm saying thank you very much for joining me today for this webinar. I'm sorry I've gone over time. It's 17 minutes past 12, very naughty. I need a coffee now. I hope you have a good day, a wonderful weekend, and please send me questions or comments. I would love to speak to you or contact your contact at Pitcher Partners. Thank you very much, guys. Bye-bye. Thank you, Michael. I appreciate it. Yes, Bridget, see you tomorrow. Thank you, everybody. Have a good day.